Attention all retirees, you need to hear this right now. The IRS has just implemented a completely new tax regulation that has the potential to return thousands upon thousands of dollars directly into your bank account, yet hardly anyone seems to be discussing it. For those of you who have reached the age of 65 or beyond, the information I am about to share with you has the potential to fundamentally transform how you manage and handle your retirement income for the next 4 years. Missing out on this opportunity could end up costing you tens of thousands of dollars that rightfully should have remained in your possession. I need you to stay with me all the way through to the conclusion, because I am going to break down in precise detail exactly how this mechanism functions, who is eligible to benefit from it, and the exact steps you need to take to ensure that every single dollar you are entitled to remains in your possession rather than being sent off to the government. Before we get into the details, I want to ask you something important. If you appreciate me bringing you these retirement tax strategies that practically nobody else is explaining in clear, understandable terms, I need you to hit that subscribe button immediately. Welcome to SSA Alert. I consistently upload these absolutely critical money-saving strategies and insights on a regular basis, and believe me when I say that once you become aware of this information, you will be amazed at how you ever managed your retirement finances without it. Go ahead and subscribe right now so that you never miss a single update, because what I am sharing with you in this particular video is merely the beginning. Let me tell you what absolutely nobody is bothering to tell you about your tax return for the year 2025, and how it is literally costing retirees thousands and thousands of dollars that they could be keeping for themselves. At this very moment, as I am speaking to you, there is a brand new regulation from the IRS that has just gone into effect, and this regulation permits seniors who are aged 65 and older to claim an additional deduction of $6,000 for individuals and $12,000 for those who are married. This is not some convoluted loophole or some kind of gimmick. This represents real, actual money that can remain in your account rather than being handed over to the government. However, here is the critical catch. This particular deduction is not permanent. It is only going to be in effect from the year 2025 all the way through 2028, which means you have got exactly 4 years to take full advantage of this benefit before it vanishes completely and forever. Now, I completely understand what you are probably thinking at this moment. There has got to be some kind of catch to this whole thing. And you know what? You are absolutely right to think that. This deduction does begin to phase out if you happen to be a single filer who is making more than $75,000, or if you are married and filing jointly while making more than $150,000. The absolutely beautiful aspect of this is that it stacks directly on top of your regular standard deduction, as well as the existing senior deduction that is already in place. We are literally talking about a married couple who could potentially shield nearly $47,000 from federal taxes. That is not some insignificant amount of money. That represents real, tangible financial relief for people who are living on fixed incomes, while watching their hard-earned dollars disappear due to inflation and constantly rising costs. Now, I need you to listen to me very closely, because what I am about to explain to you is going to have an impact on every single decision you make regarding your retirement income over the course of the next 4 years. This deduction is not just some simple accounting trick that is going to save you a few dollars here and there. We are talking about a fundamental structural shift in how your retirement income is going to be treated by the federal government. And if you do not understand exactly and precisely how this works, you are absolutely going to leave thousands of dollars sitting on the table. Let me break this entire thing down in the way I genuinely wish someone had taken the time to explain it to me when I first started learning about taxes and money management. First and foremost, you absolutely need to understand that this senior bonus deduction is completely and entirely separate from everything you already know and understand about the standard deduction. For many years now, if you were 65 years old or older, you received a little extra bump in your standard deduction, and that benefit still exists today. That has not gone anywhere at all. What is brand new and just appeared is this additional $6,000 deduction that literally just materialized this year as part of the One Big Beautiful Bill Act that was officially signed into law back in July. And here is what makes this absolutely revolutionary and unprecedented. It is available for both itemizing and non-itemizing taxpayers. Read that statement again and let it sink in. This means that whether you are taking the standard deduction or whether you are itemizing every single medical expense and every charitable donation you have made, you can still claim this $6,000 reduction in your taxable income. That is truly unprecedented. The vast majority of deductions force you to choose one path or the other, but this particular one works regardless of which route you decide to take. Now, let me paint a picture for you of what this actually looks like when translated into real numbers, because I want you to see and understand the full scope of what is happening here. Let us say that you are a single filer who is 65 years old. In the year 2025, your standard deduction amounts to $15,750. That is the baseline that every single taxpayer in the entire country of America receives. But because you have reached the age of 65, you receive an additional $2,000 tacked on top of that amount. That is the existing age-based deduction that has been in existence for many years. And now, assuming that your income falls below that $75,000 threshold, you get to add another $6,000 from this new senior bonus deduction. Add all of those amounts together, and you are looking at a total of $23,750 that gets completely and entirely shielded from federal income taxes. Think about that for just a second and let it really sink in. If you are receiving Social Security benefits and perhaps pulling a little bit of money from your IRA or your 401k, nearly $24,000 of that income is going to be completely tax-free before you pay a single penny to the government. For married couples, the numbers become even more dramatic and impressive. The standard deduction for joint filers in the year 2025 is $29,200. Each spouse who is 65 years old or older receives an additional $1,600. So that represents another $3,200 if both of you qualify for this benefit. Then you add the $12,000 senior bonus, which is $6,000 per spouse, and suddenly you are protecting over $46,000 of your retirement income from federal taxes. Let me repeat that number again so it really sinks in. $46,000. That is not some small change or pocket money. That is serious, substantial money for people who are trying to make their retirement savings last for 20, 30, or maybe even 40 years during their retirement. But here is where people start making critical mistakes, and I observe this happening all the time. They hear about a new deduction being available, and they automatically assume it is going to be applied automatically. They think that the IRS is just going to magically apply it to their tax return without them having to do anything whatsoever. That is absolutely not how this works at all. You have got to actually claim this thing, and you have got to do it correctly and properly. The good news in all of this is that the process is not complicated, but you absolutely do need to know what you are doing. What makes the bonus tax break for seniors so appealing is that it doesn't require itemizing your deductions, and it can be claimed as part of your Form 1040 or 1040 SR. Form 1040 SR is the senior-specific version of the regular 1040 form, and it features bigger print and clear instructions that are specifically designed for people over the age of 65. When you fill out that particular form, you are going to check the box that indicates you are 65 years old or older. That simple check mark triggers an entire series of calculations that the IRS uses to make absolutely sure you receive every dollar you are entitled to. Now, here is something absolutely critical that a whole lot of people are missing in all the news coverage and discussion about this deduction. This is not permanent in any way. Let me repeat that statement because it is critically important. This deduction is temporary. This new deduction is effective for the years 2025 through 2028. And unless Congress comes back and makes the decision to extend it, it is going to disappear completely after you file your tax return for 2028. That gives you 4 years, 4 tax years, to take complete advantage of this. The years 2025, 2026, 2027, and 2028. That is it and nothing more. After that time period, unless something changes in Washington, this benefit goes away completely. So if you are on the fence about making financial decisions that could potentially be impacted by this deduction, you need to be thinking in terms of a 4-year window of opportunity, not some indefinite future period. Let us talk about the income limits, because this is where things get a little bit tricky and complicated and where a lot of people are going to discover that they don't qualify for the full amount. The deduction starts to phase out based on your modified adjusted gross income, or MAGI. For single filers, that phase out begins at $75,000. For married couples who are filing jointly, it starts at $150,000. Now, what does phase out actually mean in practical terms? It means that for every $1,000 you earn above those threshold amounts, your deduction gets reduced by $60. Do the math on that calculation, and you will see that if you are a single filer earning $175,000 or more, you get absolutely nothing. Zero. The deduction is completely gone and eliminated. For married couples, it disappears entirely at $250,000. This phase-out structure is specifically designed to target the benefit to low- and middle-income seniors, which honestly makes perfect sense from a policy perspective. If you are pulling in $200,000 a year during your retirement, you are doing pretty well financially and probably do not need as much tax relief as someone who is living on Social Security and a modest pension. But here is what is interesting about the way this entire thing is structured. Your income matters in terms of how much of the deduction you can actually claim, but it doesn't change the fundamental fact that this deduction exists separately from your standard deduction. Even if you are in that phase-out range, every dollar of the deduction you can still claim represents money back in your pocket. Now let me address something that is causing a tremendous amount of confusion out there. And I want to clear this up right now because I am seeing it all over social media platforms and in conversations with people who are completely misinformed about what this deduction actually does. There is this rumor circulating around that this deduction eliminates taxes on Social Security benefits entirely. That is absolutely not true. Let me be crystal clear about this particular point. The bonus deduction does not necessarily eliminate taxes on your Social Security benefits. What it actually does is reduce your overall taxable income, which might indirectly reduce how much of your Social Security is subject to tax, but it does not change the underlying rules about Social Security taxation. Those rules are still very much in place. If you are single and your combined income, which is your adjusted gross income plus half of your Social Security benefits, exceeds $25,000, or if you are married filing jointly and it exceeds $32,000, a portion of your Social Security is going to be taxable. This deduction might help lower that taxable amount, but it is not some magic wand that makes all Social Security taxes disappear completely. Here is what actually happens when you apply this deduction to a real-world situation and scenario. Let us say you are a single retiree receiving the average Social Security benefit, which according to the Social Security Administration is approximately $24,000 a year. Up to 85% of that benefit could potentially be taxable under current law, which would amount to approximately $20,400. But with the standard deduction of $15,750 plus the existing $2,000 age-based addition, plus this new $6,000 senior bonus, you are looking at total deductions of $23,750. In this particular scenario, your deductions actually exceed the taxable portion of your Social Security, which means you would likely owe very little to no federal income tax. That is powerful and meaningful. That is genuinely life-changing for someone who is living on a fixed income. But let us talk about a more complex situation because not everybody is just living on Social Security benefits alone. Maybe you are pulling money out of your IRA or your 401k retirement account. Maybe you have got some dividend income coming from your investments. Maybe you have got a part-time job or rental property income coming in. All of that matters significantly because all of that factors into your modified adjusted gross income, which determines how much of this deduction you can actually claim. Let us say you are a single senior with $40,000 in Social Security benefits and another $40,000 coming from your IRA. Treasury Department calculations demonstrate that under current law, you would owe approximately $7,915 in federal taxes. But with this new senior bonus deduction, that tax bill drops to approximately $5,685. That represents a savings of over $1,500. For a married couple in a similar situation, the savings could be even more substantial and meaningful. The key to maximizing this deduction is understanding exactly how your income sources work together and how they impact your overall tax situation. This is where a lot of people make absolutely critical errors. They do not think about the timing of their retirement account withdrawals. They do not consider whether it makes sense to delay taking Social Security or to start drawing it early. They do not look at the bigger picture of how all their income streams interact with the tax code. And when you are talking about a deduction that is only going to be around for 4 years, timing becomes even more important and critical. You might want to accelerate certain income into these 4 years when you can take advantage of the deduction, or you might want to defer other income until after the deduction expires. These are strategic decisions that require you to actually sit down and map out your entire retirement income plan. Here is another thing people are not talking about enough. This deduction works whether you are still working or you are fully retired. As long as you are 65 years old or older and you meet the income requirements, you can claim it. So if you are one of those people who is 67 years old and still working part-time because you love what you do or because you need the extra income, you can still benefit from this. You are not disqualified just because you are earning wages. The only thing that matters is your total modified adjusted gross income and whether it falls below those phase-out thresholds. This is particularly important for people who are in that transition period between full-time work and full retirement. Maybe you are scaling back your hours but not completely stopping. This deduction can provide meaningful tax relief during those transition years. Now, let us talk about the mechanics of actually claiming this on your tax return, because this is where people get nervous and start worrying they are going to mess something up. The process is actually pretty straightforward and simple. When you file your taxes for 2025, which you will be doing in early 2026, you are going to use either Form 1040 or Form 1040 SR. Most seniors prefer the 1040 SR because it is designed specifically for people over 65 with larger print and a clearer layout. There is a new schedule called Schedule 1A that is specifically for additional deductions, and that is where this senior bonus gets calculated. You do not need to be a tax expert to fill this out, but you do need to be careful and methodical about it. The form will walk you through calculating your modified adjusted gross income, determining how much of the deduction you are eligible for based on your income level, and then transferring that amount to the appropriate line on your main form. What I absolutely love about this deduction and why I think it is actually a pretty smart piece of policy is that it recognizes the reality of what seniors are dealing with right now. We have had years of inflation eating away at retirement savings. Healthcare costs keep climbing higher and higher. Prescription drug prices are absolutely outrageous. Property taxes are not getting any cheaper. For people living on fixed incomes or mostly fixed incomes, every dollar matters tremendously. $6,000 in additional deductions translates to real money in your pocket. If you are in the 22% tax bracket, that $6,000 deduction saves you approximately $1,320 in actual taxes. That is $1,320 you can use to pay for prescriptions, to cover your Medicare supplement premiums, to handle unexpected car repairs, or to enjoy life a little bit more. It is not going to solve every financial problem you have, but it is meaningful relief for millions of Americans who have worked their whole lives and are now trying to make their money last. The other thing I want you to understand is that this deduction is part of a broader package of tax changes that came through in the One Big Beautiful Bill Act. There were also new deductions for tips, for overtime pay, for car loan interest on new vehicles. The entire package was designed to put more money back in people's pockets across different age groups and income levels. But this senior bonus deduction is specifically targeted at older Americans, and it is one of the most generous provisions in the entire bill. The fact that it works whether you itemize or take the standard deduction makes it incredibly flexible and accessible to virtually every senior who qualifies based on income. Here is my challenge to you. Do not wait until the last minute to figure this out. We are talking about your tax return for 2025 that you will file in early 2026. Tax season is going to open in late January, and if you wait until April to start thinking about this, you are going to be stressed and rushed and more likely to make mistakes. Start planning now. Get your documents together. If you have got a tax professional you work with, schedule an appointment early and make sure they understand this new deduction. If you are doing your taxes yourself, take the time to read through the instructions carefully and make sure you are claiming every dollar you are entitled to. Do not leave money on the table because you did not understand how the deduction works, or because you were too overwhelmed to deal with it. And please, for the love of everything, do not fall for scams related to this. I guarantee you, there are going to be people out there trying to charge you money to help you claim this deduction, or telling you about some special secret way to maximize it. The information is all publicly available from the IRS. Your tax software will handle the calculations if you are filing electronically. You do not need to pay some random person on the internet to tell you about a deduction that is literally written into federal law and available to anyone who qualifies. Be smart, be careful, protect yourself. The bottom line is this. If you are 65 years old or older and your income is below those phase-out thresholds, you need to be claiming this deduction. It is real money. It represents substantial savings. It is a benefit that Congress specifically created to help seniors manage the financial pressures of retirement. Take advantage of it while it is available because remember, it is only here for 4 years. Do not let this opportunity pass you by. This is SSA Alert reminding you that your future self will thank you for every dollar you save.